let's also say that we purchased 50,000 of own money and borrowed the other 50,000 from our broker at 10% interest. Valued at its market price, our stock saves us our collateral. If shares have risen in value of $115,000 after 1 year, we can sell them and pay our broker 55,000 against $55,000 against the principal loan of 50,000 plus 5,000 interest. We will have 60,000 left over. Our original investment was that of 50,000 and will have earned us 20% profit of 10,000. If we had paid the entire price out of our own pocket, we would have earned only a 15% return. Although investors often recognize possible profits to be made in margin trading, they sometimes fail to consider that losses too can be amplified. The rising use of margin credit by investors had become a growing concern during 1997-2000 bull market. Investors who seemed focused on the upside benefits were confident that the market trend would continue upward and they were less sensitive to the downside risk of the margin trading, especially at online brokerages, especially at online brokerages. Inexperienced traders were borrowing at an alarming rate and some were using the borrowed funds for the risky and speculative day trading. So called day traders visited websites online to buy and sell stock in the same day. This trend, in fact, was riskier and brought damage to the sales. And when the brokers are doing such a practice, they need to inform and guide the clients as well. But as the representative of the many of the brokerages even are not very well experienced and they are the new people in the market, and in fact they are in the learning process, many of the representatives even don't have the clear picture, the clear idea. Seeking quick in and out fractional gains on large volumes, many shares of each stock may collapse. While some day traders were successful, most ended up financial losers. With more investors buying on debt, more of them headed for a serious accelerated crash. Bradley Skolnick, president of the North American Securities Administrators Association, voices the opinion held by many investment experts. A lot of people are purchasing rather speculative, high risk stocks with borrowed money, and that's a source of concern for us. In a volatile market trading, margin can find us in a whole lot of hurt, and we get very quickly hurt in our business patterns. Short sales. In addition to lending money, brokerages also lend securities. A short sale begins when we borrow security from our broker and sell it one of the few times that it is legal to sell something that you do not own. At a given time or the given point in the future, you must restore an equal number of shares of that issue to the brokerage along with the fee. We now return to our gap example. Suppose that in January we believe the price of gap stock will soon fall, so you therefore order your broker to sell short 100 shares at the current market price of 24.15 per share. Your broker will make the sale and credit 2,415 to your account. If GAP's price falls to 18 per share in July, you can buy dollar you can buy 100 shares for 1,800 and use them to repay your broker. You will have made a 615 profit before commission. Your risk, of course, is that GAP's price will not fall. If it holds steady or rises, you will take a loss. Securities market regulation. In addition to regulation by government agencies, both NASD and NYSE exercise self regulation to maintain the public trust and ensure professionalism in financial industries, in financial industry.